Now, what I'm going to start off by showing is that Hayek and Friedman disagreed profoundly in this area of public policy. So I'll do that. The aim of this is to, in a sense, to make you interested. All right. This area of economics is not settled. Okay. Anyway, so what we've got is that these two characters, I met both of them, by the way, so lucky to have done so. They are at opposite extremes in this subject. Hayek, late in his career, advocated his choice in currency was 1976. Denationalization of money was a slightly later. It was 1978, actually, was the pamphlet. And the idea here is that all money is issued by the private sector, and the private sector suppliers are to compete. Okay. Now, Friedman wrote various things about this subject through his career, and what I'm going to say may be a simplification. All right. But certainly at various points in his career, he advocated what's called 100% cash reserve banking. Now, this originated it's a very old idea in a sense. The Hamburg Bank was an illustration of it. The talk this morning illustrated it. But the idea is to back the paper liabilities of a bank 100% by something very safe, so then the banking system is very, very safe, all right? And what happened, arguably, I agree with this argument, in the 1920s and 1930s in the USA, was that most of the banking system's assets were claims on the private sector. They had some government securities, but most of them were loans to the private sector. The rate of growth of the bank's claims on the private sector fluctuated radically, going up steadily enough in the 1920s, collapsing in the early 1930s. That then, the creation of money by the private sector led to fluctuations in money growth, including the fall of a third in the quantity of money in the USA, the early 90s, then the Great Depression. So various people in Chicago, in particular, also Yale, Irving Fisher was Yale, advocated that the influence of the private sector on the amount of money through these lending operations should stop. And they said that bank deposits should be backed 100% by cash, but with some variations of ideas. There's sometimes it's only demand deposits, current accounts to be backed by cash. Sometimes it's cash and government securities. At any rate, Friedman was in favor of this, and this meant that money is to be 100% backed by the state. So you've got these two figures, the greatest, most lionized figures in free market thinking in the late 20th century, with utterly different views on this topic. And you've got me saying they're both wrong, by the way. But anyway, that's as we'll go through this afternoon. So just a little bit more about Hayek. And this is the quote by a chap called Arthur Selden in the preface to that book. Professor Hayek is arguing that money is no different from other commodities and better supplied by competition between private issuers than by a monopoly of government. Just before I move on that, this is the period when in Britain we had inflation briefly at almost 27%, and we also had, at that time, there were exchange controls, so you couldn't easily convert. You could, but you had to go through the Bank of England, all sorts of bureaucracy. You couldn't easily convert pounds into Deutschmarks, whatever. And okay, so that's the background to Hayek's proposal. It's sometimes said that cryptocurrencies are in fact a manifestation, embodiment of Hayek's proposal. And these are at last competing private sector monies. There's a paper there last year from Meyer and Bofinger which says that. And then, again, briefly discuss a little bit more about Friedman Now, he had a 1948 paper which very explicitly had the 100% cash reserve idea in it. There was a lot about fiscal policy in that, and he dropped the paper in effect. He did in effect repudiate it. But even in 1959, by then his ideas have been on money management pretty much stabilized. And he gave these lectures in New York where he did refer to 100% cash reserve idea, but not with the same prominence as 1948. And I was actually there in 1981. I can't remember it now in detail, but when he gave a talk about money in the state in Monetary Society in Vina del Mar in Chile. But in that, I can't remember referring to this, but he said various things various times. He certainly did bless this idea more than once. It wasn't just him, to be clear. It was Irving Fisher, who, they'd gone through the Great Depression. He lost all his money in the Great Depression, and he wrote a book in 1935 on 100% money, designed to keep checking banks 100% liquid, to prevent inflation and deflation, largely to cure or prevent depressions, and to wipe out much of the national debt. And to clarify that this was a Chicago idea. One of Friedman's teachers at Chicago, a chap called Henry Simons, and he'd put out something called 1934 a positive program for laissez-faire, which included the 100% cash reserve proposal. And this was something that appeared in his 1948 book, Economic Policy for a Free Society, which actually was reviewed, by the way, Boris by Oakeshott in his book 1952 on, what was it called now? Anyway. So all these people are linked up. Economic Policy for a Free Society. You'll see what I've added there. 100% cash reserve requirement is hugely interventionist. All right? We've got a banking system. We've got bankers who compete, yeah? This is telling me how they run their businesses, yeah? This isn't, to me, this isn't free society. And debate and discuss. Now, so, Keynes wasn't interested in this stuff. Wasn't interested. Fisher wrote to him. The letters are all in the 32 works of Fisher. He just wasn't interested at all. Not practical. All right. What I would say, though, about both of these people, both of these great thinkers, is that they do share extreme radicalism. That's very clear. Yep, because these proposals are tearing up the existing situation, right? Hayek wanted to scrap legal tender laws, end state involvement in money creation altogether, and Friedman's, Fisher, Simons might say it's a bit less radical, but it's still pretty radical in the sense that the profit-motivated, privately owned banking system would be subject to a massively interventionist government regulation. So the only shared aspect of the very different treatments was extreme radicalism. You might say it's related to freedom. Well, again, debate and discuss. On the contrary, these guys didn't regard themselves as conservatives. They both thought themselves as classical liberals. To me, what's important is what works. What I'm going to argue now is that money and banking, the situation, the institutions we have today, have developed over time. The processes can be understood as organic and evolutionary, and therefore they constitute, the status quo is a spontaneous order. Now, I've said that deliberately, because if Friedrich Hayek was here, I'd say, look what I'm just saying, because he says what other people say, like Larry White and George Selgin, it's an imposed order. I couldn't give a damn, it's of course a conservative. I'm not an anarchist, and neither Friedman nor Hayek would want to be described as an anarchist. They both accept that there should be a government. And this then leads lots of discussions as well, okay, because you believe in freedom. Do you believe in freedom without license or freedom under the law? A lot of discussions about that. To be clear, these guys weren't anarchists, neither am I. So we're talking about a society, about societies with a government. Government has financial operations, it does tax, it does spend money. It therefore needs a fiscal agent, it needs a bank. So in any society, there will be a banker to the government. That's very important. We're going to pick that up later on. All right. Now, I'm just very quickly going to describe the current system as I see it, and then I'll explain how this develops. What we see in the modern world is, this is universal. All liberal democracies have basically the same system. There is a central bank, all right? So Hayek wanted to end central banks, okay? That was part of what he said in 78. Friedman, although they're basically, in some sense, at opposite extremes in this subject, he did also, at some points in the 50s, advocate just an automatic increase in the monetary base. That's all that needs to happen. That can be done by the government, no need of the central bank. He did say that in one of his debates. I think there should be a central bank, and this central bank has a monopoly right, issue legal tender money, which is really the origin of its power. That's really the basis of its power. The state, it may be the government, it may be the legislature, it varies. The state tells the central bank its job is to keep the real value of that money fairly stable. That's monetary stability. That's so even though modern circumstances with the fiat money world, the money has no intrinsic value. It's not backed by a commodity. The central bank is also sort of expected to maintain financial stability, which means the convertibility of the banking system's liabilities into legal tender at 100 pence in the pound, 100 cents in the dollar, and so on. All right? And it provides services, banking services to the government, the bank to the government, and also to the banking system, lender of last resort job, in order to maintain financial stability, and also then looks after all sorts of things that are happening on commercial banks' balance sheets. And the central bank is separate from the commercial banking system. The central bank is not expected to make a profit. It doesn't have to make a profit because its real goal is the social aims of monetary stability and financial stability. But it shouldn't make a loss. Commercial banks, they exist to make a profit. I mean, you may think that they're utilities or something. No, they exist to make a profit. And there are maybe something mutual and so on, but they basically exist to make certainly a surplus. And what we find also, and this is again universal, is that they are fractionally reserved. The cash isn't 100% of their assets. It's some tiny fraction of their assets. And they're also highly leveraged. Two very risky aspects of their balance sheets. Of course, offset by the fact that the assets must be very safe, and they can go to the central bank, which can produce, in modern circumstances, money out of nothing. They can go to the central bank to get their cash replenished if they're subject to runs. Okay, and this just elaborates that. There is there's a kind of sub-controversy in all of this about whether the central bank's job is whether it should have a lender of last resort responsibility. This is tied up with the issue we had this morning about the Hamburg bank had the lending bank, and then the bank of issue, and then the issuing bit, which is the gold certificate, silver certificate, totally matched by gold. That comes through in the Bank of England's split, the issue department, the banking department, 1844. They couldn't sustain it because actually the job of being lender of last resort meant that the banking department had to work with the issue department. I won't go through the details there. But however, you do get people saying that the central bank should be Ricardian. It shouldn't get involved in lending to banks, shouldn't be in this business, against those who say it's Bajottian, where I stand, and that it should be. Anyway, so we've got all of these. These are the. This is the current system. Now I'm going to spend a bit of time on Hayek. I may be a bit cavalier here, and if I upset people, I'm sorry. And then I'm going to talk about. I'll talk a little bit about Friedman, and then I'm going to get into the real guts of the presentation. So, look, competition appears to be a desirable feature of. It is not the case that competition is the only way in which individuals can interact. Obviously, the notion of different governments in a single state would be catastrophic. And this is really the point of books like Hobbes' Leviathan and No Sixth Anarchy State and Utopia. Different governments, they will have the means to fight. Having lots of different governments in one nation state would be a recipe for anarchy. We don't want competition between governments. We want one government, please. Okay? We don't want competition in parenthood. You know, there's natural parents, they should bring up a family, it's the best way of doing it. Having balmy, or even in a more purely economic sphere. This is really Ronald Coase's brilliant demonstration of this, but there are companies. I mean, companies, you're told what to do. You know, there's no question about, this is my price, hire me if you want to or not. You're told what to do. And you accept that, the fiat mechanism works, because it's more efficient. Sorry, it's more efficient than the price mechanism in competition. You avoid all the contracting costs, all the transaction costs. So companies exist with the fiat mechanism because they're more efficient than the price mechanism. It's more efficient than competition. All right? There's a bit of this also in Neil Ferguson's 2017 book on the square and the tower. So it is simply not true that in even economic relations, that we want competition all the time. So this use of this word competition is mischievous. Okay, it's not. You know, we need to work out what is good and what is. And look, frankly, in the case of money, competition is balmy. Just think. I mean, it's just Hayek. I mean, great thinker. They can have bad days. Look. You go to a shop one week and the prices are quoted in one unit. You go to a shop a week before, it's quoted in a different unit. These things are competing. What a blasted nuisance. Do we want our bank statements 1 month in Ethereum, next month in Bitcoin? What a load of nonsense. We want one money, for God's sake. All right? Because that makes life much simpler. Just as we want one law, we don't want competing legal, different sets of laws in one nation. We want one law, one government, and in most places, one money. Doesn't close down the question of whether it could be provided by the private sector, but I'm sorry, this is just nuts. There are problems over and above this, but look, I've got these things, I think I've got one in my pocket at the moment. What is the production cost of this £5 note? Twopence? There's a difference between that and the production cost. Who does that belong to? There's a massive profit through issuing money which has no intrinsic value. This may be issued by fraudsters. Obviously, there is this whole question of crypto, and that's another topic, and I don't want to hide the fact my views are very jaundiced. I think it's essentially crypto is of great value in the criminal economy, the black economy, and the grey economies. There is a genuine demand for the services that crypto provides. And if you're getting involved in that, you just be aware of what you're really investing in, all right? Okay. So now this is much more difficult, and it keeps on coming back. This idea of we can make money safe by backing it 100% with something, 100% by something that is safe. It just keeps on coming back. And so I'm going to just set out now the argument that I gave in my MSc course to explain how the current system developed. Okay, so we start off with a goldsmith. And he's got a lump of gold. He's got no idea he's going to become a banker. And the gold is to be converted into jewelry. And all right. Because he's got this valuable gold, which can be stolen, he invests in safe boxes and infrastructure of security. So he sets himself up as a business. In businesses, so far there's nobody else invested in the business. It's just his capital there. That's the liabilities, and the assets are his gold. He's got the security, he's got this strong box and so on. Well, he can offer custody services to third parties. I'm sorry if I say he, but it should be he and she or she, but anyway, he and she. But if he takes any deposits of gold from third parties, then he must make a profit on that. This is a question I asked this morning. And so may well develop a business where he has got these safe boxes and look after the extra gold, and he gives, there's the blue bit, the dark blue bit, these are receipts for gold that he looks after. He hands over, those are the liabilities of his business. He's still got his own capital, he's still got his own gold, and the assets, 100% gold, 100% cash reserve, okay. Two things happen, but notice receipts, gold certificates, notes, okay. So, two things happen. The first thing is that the goldsmith can start making loans because the depositors of gold don't always come back at the same time to get their money out. And so you can use these timing differences to make loans on which he charges interest, and that he then makes a profit on, unless he starts to stop demanding custody fees from the depositors, even starts to pay depositors some interest himself. So the loans are being made in gold. Okay. So this is the balance sheet. Some of this gold is now in the form of loans, repayable in gold. It's no longer 100% cash reserve banking. You can see why it's done. It's for profit. Okay? That's why I asked that question this morning. What would the profit of the Hamburg Bank have been? All right? Now, something else happens. Paying with gold is terribly awkward. You've got to weigh it. You've got to, again, it can be stolen. So you've got to make sure that when you're moving it around, that it's protected. It's very awkward. Making payments purely in metal is very difficult. So depositors, the holders of these notes, start to make payments in the notes. And in a certain area, they may well become widely acceptable, usually often an area defined culturally or with recognizing the same law. Often people know each other very well, the same religion or whatever. They don't typically at this stage have legal tender status. They remain convertible back into gold, all being well. But notice I'm starting to talk about the law. Okay? And in a nation state, we have one government, one law. Okay, all right. Okay. So the receipts are starting to be used in payments. The notes are starting to be used in payments. Now we come to the eureka moment. This is where everything really changes. And where this began, nobody really knows exactly where this first happened. But the notes can be used in payment. Then, and the banks are making loans. This is the balance sheet just before this key change. And this is the key moment. The key moment is when the the loans are made not in gold, they're made in notes. All right? So that this is, the goldsmith banker has enough credibility within a certain location, subject to a set of laws, that these notes can be used to make payments. They can be loaned out without a prior deposit of gold. The balance sheet can expand without the earlier receipt of gold. This is the break, okay? And banking proper begins. It's actually in the, by now it's pretty conscious what's going on, it's in the conscious ending of the 100% cash reserve idea that banking begins, all right? For a banker, the notion of cash reserve is a negation of what they do, all right? So the goldsmith is becoming an embryonic bank, then it becomes true banking. Notes aren't backed by gold, not 100% in practice. They are redeemable still into gold, become a higher and higher share of the balance sheets. The interest-bearing loan assets obviously generating a profit, and they can become eventually larger than the gold in the vaults and the tills. The loan assets must be very safe. And one of the results of this, I've been showing how the balance sheet grows, is just, so there's the goldsmith's capital there, all right? And as this process of expansion takes place, the goldsmith's capital becomes a smaller and smaller share of the total, all right? So the capital goes down relative, but there's then profits being made on those assets, so it's generating very high rates of return unless there's competition, which drives down the spread on the loans. At any rate, banks are inherently highly leveraged. Shocks many people when they find out how low these ratios are. All right. Now, this is an academic conference, so you can be, I'm going to inflict some algebra on you. In simplest form, the assets are the cash and the loans. So A is cash. The cash is C, but it's the proportion of cash to assets, C, A, plus the loan book, all right? The loan book generates the profits, okay? And no profits are earned on cash. Gold, pointless, you can't get interest on gold. The profits are going to be, depend partly on the size of the loan book, but also the spread, S. Okay, we then determine this spread. So profits are going to be the size of the loan book, L, the spread, and that's the profits figure. The return on capital is going to be P over K, which is same as that, okay, because that's, we just divide P, both sides of that, by K, and that then gives us that. The assets are going to be that minus the cash, and then this gives us that expression there. So the spread, the cost of borrowing from the banking system, all right, this is very important if you're a businessman. I got a question about the natural, what do we stop ending government control? That is the spread on the cost of loans. You know, you go to a bank and you want a mortgage, what determines that spread? Well, of course, the bank's got its costs, yes.
Spread? I'm not familiar with the...
What's that?
How would you define spread?
The bank has a cost of funds. Then there's the spread is the percent above that. So typically when I get a loan from a bank, it varies a bit, but usually it's bank rate plus, say, 175 basis points. In the recent past, more like 250, 300 basis points. But some years ago, it was more like, even for me, it was like 150 basis points. So that 150 basis points is a spread.
Okay.
Is that all right? Does everybody else understand what I'm talking about? All right, okay. Now, this is a chap called Phillips. He was a banker. He wrote a brilliant book, 1909, called Bank Credit. The essence of banking consists in the practice of extending loans far in excess of either the capital or the cash holding of the bank in question. Okay? So taking risks both these ways Of course, keeping costs down, but that's what they're doing. That's not 100% cash reserve banking, please. That's what they think that's what bankers themselves think they're doing. They're appalled by the idea that all their assets are cash. They haven't got a job. Anyway, so this then, we want to talk about how this spread is determined. And this is quite important to the bank's customers, because this affects the cost of banking services to them. Suppose that the cash ratio, this is very early days, his cash ratio is 80%. Still really a kind of Goldsmith banker. Suppose that the capital is still 45%. Much of the liabilities are still, it's still really Goldsmith, really. Then to make a 14% return on capital, the guy's got to charge, I'm sorry, it's all he rather than he and she, but the guy's got to charge 32%. All right? Now, you might say that's absurd. This isn't banking. It isn't banking. It's money lending. But if you go, say, to Somalia today, you go to a money lender. There'll be money lenders in Somalia today, and they will charge you chaos. Somalia, they'll charge you fantastic margins. These kind of things in developing countries happens. How can that ever make sense? These places, I mean, I'm sorry if I know one or two people perhaps in these countries, but the value of a car in one place is a fraction of what it is in another. So there's a dealer, he buys the car there, sells the car there, he makes 100% in a fortnight. He's prepared to pay 32%, okay? So, by the way, second-hand car dealers in the UK make pretty good margins too, and they go to outfits in Birmingham and elsewhere where they also charge pretty handsomely for the loans you get. Okay, other extreme. Suppose your cash ratio is 1%, and all your assets are being used. And the example I'm going to give, most of the assets are actually interbank loans. They're loans to other banks to be very safe. And suppose that your capital is just 3% of your assets. How can you possibly, I mean, this is this is, say, Euro currency banking in London before the capital rules came in, say, the early 1980s. And they would charge 40 basis points for a loan, all right? Nothing. And they could do that because these ratios have come down to... Now, which I put to you of these situations is most beneficial for society? Is it this one or that one? All right? So I put it to you that this process of reducing the cash reserve ratio from 100% to 1% in this example is socially beneficial. Fractional reserving leverage benefits society. All right? Now I know that you would go to, if you put this in front of the Daily Mail and said, I've said this, and suppose I was Chancellor of the Exchequer and said this, so this would be, this man's mad. No, clearly the way the system has evolved has deliberately to make banking and its services affordable and useful. So then we have great availability of mortgage finance, we have greater availability of overdrafts, greater availability of project finance. So we have societies with a higher ratio of capital to assets, capital to labor, higher capital intensity to go to the Austrians. We're richer. Well, the other process of development is that the role of commodities as backing for paper money gradually diminishes. And I'm going to move very quickly, but I need to say two things. The use of the commodity in the provision of money services diminishes, which saves in terms of transactions costs, because using paper, scriptural money, electronic payments is much less expensive than using metal, just metal by itself to make payments, rather obviously. But the other aspect of all this, and there's also, we don't have to use the resources to get the gold out of the ground. There's another aspect of all this, which is that banks are always subject to runs. You know, I've gone through that case where the cash ratio goes down to nothing. There can be runs in the interbank market, you know, as happened in 2007, actually also 2006 to some extent. And so even, you know, quite good banks will want to have access to a safer bank from which they can borrow cash. And the safer bank in turn will want to be able to borrow, if they're subject to a run, they want to borrow from another safe bank. And so this system of reserving and reserve banks going to reserve banks will ultimately focus on the safest bank, and the safest bank is the banker to the government. All right? So the safest bank, the banker to the government, becomes the lender of last resort. All right? Let's just be clear, as I said earlier, we're talking about societies with a government. We're not talking about anarchy. Okay. Which bank becomes central bank? A safest bank, which is usually, I mean, almost invariably, the bank of the government. You then get, as I said just a few minutes ago, you get this technology of payments evolves. We economize on the use of the commodity money. The commodity backing for paper money diminishes. Commodities finally aren't being used. It's just purely fiat money. And so, and this too, in my view, is socially beneficial. You know, imagine trying to make all the payments of the modern world with gold, you know, all right? There's these things, these are the processes I've been talking about. They culminate in the system, the status quo that we see in the modern world, and therefore I provided a justification for the system that we see in the modern world. Just, I've gone and summarized that there. I put this in red because this is really to antagonize, in a sense, if you wish, people like George Selgin and Larry White, who they say that the central bank is bank of the government, and this is something imposed on the private sector, which otherwise wouldn't accept this. No, there's a logic to what we have. So this is really my reply to Friedman, that he is actually advocating, despite being, if you like, you know, one of the strongest advocates of the free market economy that we can think of. He's actually advocating something which is a retrogression. It's going back to where the whole thing started. All right, I won't go through this now, but for example, in the 1959 Miller Lectures, he advocated, as part of this 100% cash, that there should be interest payments on banks' cash reserves. Please, where do they come from? Does the government pay them? What's this? It's a government subsidy for banking. Banking which can't lend money because all its assets are cash. What's this got to do with the free market economy, for heaven's sake? He wrote this book with his wife called Free to Choose. In favor of freedom in business and so on. Until we get to banking, when, you know, these banks are being told, but you can't do that. You can't lend more than all your assets got to be cash, you know. What's free about that? In my view, what's being advocated here would be both very inefficient and illiberal too. So, just to finish this off, that I'm in favor of the status quo. Please, these are the arrangements you find in country after country, country after country. It's perfectly true that in planned economies, when they still had communism, banks were very different kind of organizations. They were part of the planning mechanism and were not part of the market economy. But even in Russia, certainly in Eastern Europe, what they've moved to is not 100% cash reserve banking or competition in currency. They've moved to exactly the same system that is seen in all the Western liberal market economies. So there's then a little comment about Bagehot. This is a little bit digression, but Bagehot wanted a number of banks of issue, not one. The problem with that is it actually was a live issue in the United States in the 19th century. They had many different states. Banks were specific to a state, not to the USA as a whole. The question of which bank should take the government's deposit was then one of political favoritism. This is a topic all through the 19th century in the USA. No, there should be one a bank of issue, governments, and so on. All right. There is another topic here, which is, should the central bank be owned by the private sector or the state? And in my view, there is a case for the banking bit of the central bank's operations being owned by the private sector. I did, in my 2009 Central Banking in a Free Society, advocate the denationalization of the Bank of England. By the way, I was fascinated by what Forrest said about the bank's profitability. None of that's in the public domain. Apparently, it's absurd. I'm not surprised, by the way they bullied the banks in the Great Recession, that in the subsequent years, the banking became fabulously profitable. None of that's appeared in the newspapers. Anyway, the banking bits, where the central bank lends to the commercial banks every now and again, and by the way also takes deposits from the central banks much of the time, the deposits then being used to settle money in the clearing. That bit could be owned by a public-private partnership, if you wish, where if there are big losses on the last resort loans, then the bank shareholders must pay up, not the government, not the taxpayer. So sorry, Martin Wolf, all this stuff about socializing losses and stealing the profits, rubbish. If the banking operations of the central bank are owned by the private sector, owned by the banks themselves, then they have an interest themselves in making sure that all banks are going to be properly run and don't cause a loss to the fund. Of course, you then get issues about competition. By the way, this also happens at Lloyd's of London, where I provide capital. They have a central fund, and Lloyd's checks what all the syndicates are doing. Nevertheless, there is fierce competition. So, that could be done. Part of what the central bank does could be privatized. The note issue, no. The profits note issue goes straight to the government. And either way, this stuff going on at the moment where the profits note issue or equivalents go to fraudsters in the crypto world, that's all wrong. I've covered the ground. Have I any more to say? Oh, yes. Look, this evolution has been a product of human action, not of human design. Did that Goldsmith back in the late 17th century have any idea this is going to happen? Any idea that there's going to be this process of evolution over the next 300 years? Of course not. It is therefore a spontaneous order, so much admired by Hayek. It's not an imposed order. Sorry, George and Larry, no, I don't agree with you about that. Now, having said that, when you look at the historical record, many central banks were indeed set up by the government in wartime to raise money. Debate and discuss. I think I've covered my ground, and anything else to say, there we are. Very good, thank you.